date listed? Just says to
Just
be
got
announced.
listed 2 weeks ago. And then date is December 16th.
Just
I'm
September.
sorry, May 15th.
May 15th.
It's
Perfect.
a Monday.
Monday. Thank you so much.
Couple of reminders. One is that if you want your DCF to get feedback, you need to get it in by this Friday. There's no particular time. It's not like I'm going to be waiting at 5 o'clock because it came in at 5:01. In fact, if you don't get it on Friday and you get it on Saturday morning, just get it in. And try to follow the protocol that I sent you on. You remember what I said? When you send the DCF, what should you do? And the subject, make sure you include my perfect DCF. Please don't try to be clever by putting things like my imperfect DCF, my lousy DCF. This is a computer. It has no sense of nuance. It's a smart mailbox in the Mac. It looks for my perfect DCF. It sees my lousy DCF. Your email will go somewhere else. So there are lots of places you can be clever. This is not the place I want you to try to be creative. Just say my perfect DCF. This is not some Tony Robbins exercise that I'm doing of positive thinking, where if you say my perfect DCF, it's going to turn positive. It's just I need it to be in one place so I can, because I'm going to get 300 DCFs in like 2 hours. And I'd like them to be in one place, so as I go through them, I'm not looking for your email and seeing it's a DCF. So please try to follow that. And usually you'll get it back pretty soon. Like I got 2 DCFs, one yesterday and one, and you don't have to wait till Friday. So if you're already done, you send it in. you will get it back pretty quickly. So, and maybe 15, 20 minutes after you send it, you might get it back. If it's because I look over it, looks pretty good. And even if it's not, I'll usually catch the things I need to catch. So you should get it back pretty quickly. So if you don't hear back by Monday morning or Tuesday morning, then I'll keep you updated as to where I am. If something happens this weekend, I'm not able to get to the DCFs, and you might not get it till Monday, but you'll get it back sooner rather than later. Okay. Let's talk a little bit about what's coming today. Again, let's start the class off with those questions. Okay. Today we're going to talk about, maybe towards the end, about emerging market companies. And in particular, we're sometimes going to talk about companies that are poorly managed, because as you said, lots of companies around the world are poorly managed. Right? You have a badly managed company, you've done a discounted cash flow valuation of a badly managed company. This is also a company where you have zero power to change the management. You have bad corporate governance. Should you be discounting your discounted cash flow valuation for bad corporate governance? What do you think? You've done a discounted cash flow valuation of a company where you realize you have no power to change the company. Should you be discounting the value? What's the problem? When you say bad management, what are you talking about? You're talking about companies that take bad projects, fund them badly, pay out very little in dividends. Now, when you did your DCF, you estimated the cash flows, right? And what do you base those cash flows on? How the company is run. It's badly run, you put in bad returns on capital. If it was badly funded, you gave it a high cost of capital. If it didn't pay out enough in dividends, you gave it that. So your DCF, if you've done it right, should already reflect the bad management. So today we're going to talk about where exactly do you show corporate governance, and if you've done your DCF right, one of the things we're going to talk about is that DCF already reflects bad governance. Let's take a second question. I talk a lot about capitalizing R&D, especially with pharmaceutical companies and technology companies. And if you think about capitalizing R&D, it seems like I'm doing a lot of work for very little, because here's what I do. When I capitalize R&D, I take R&D out of the operating expenses and I make it a capital expense. So what that does usually is it pushes up the operating income, but it also pushes up my reinvestment, because now R&D is part of my net capex. My free cash flow to the firm, what happens when I capitalize R&D? All I've done is moved it around. The free cash flow to the firm remains unchanged. You say, why do we waste our time doing it? So here's my question for you. When I value this company, and I use a traditional accounting, I value the company, and then I revalue the company capitalizing R&D. So I moved it from operating. Okay. What will happen to my value per share for this pharmaceutical company? Will it remain unchanged? Because after all, the free cash flow is what we look at, and that doesn't change. Should the value go up? Because earnings will go up. Should the value go down? Because reinvestment will go up. Or any of the above, depending on the company. What exactly are we trying to do when we capitalize R&D, and will it have an effect on value? Let's take each part of the question. Do you think it will have an effect on value? If it did not have an effect on value, would I even bother going through that? Clearly, I did it because I thought it had an effect on value. And how will it affect value? Increase it, decrease it, or leave it unchanged? I'll give you a clue. When you move R&D into capital expenditure, what's the question you're asking about R&D? R&D is like any other project, right? So what's the question you're asking about your R&D? What's the return you make on your R&D? R&D by itself is neither good nor bad. You can be a good R&D company, in which case you generate a return greater than your cost of capital, in which case R&D creates value. You can be a neutral company where R&D kind of runs in place and does nothing for value. Or you can be like Merck, a company that does R&D, shows nothing for it, and destroys value. That's why we capitalize R&D, to make sure that you're the kind of company where increased R&D is going to increase value. So I'm going to show you what happens to Amgen when I value the company as is, and then when I capitalize R&D, and you're going to be amazed at how much of an effect it has on value per share. Third and final question. Today we're also going to talk about, as I said, the most depressing part of DCF valuation is valuing a declining or a distressed company. Okay? So let's say I give you a distressed company. 1 in 5 of you is a money-losing company. Let's say it's a money-losing company with distress. So it's losing money. It's got huge amounts of debt. But you do a DCF and you do everything you're supposed to do. You know what I mean by supposed to do? How do you fix a money-losing company in a spreadsheet? You make it a money-making company. It's easy to do on a spreadsheet. You fix its debt ratio. You make it a healthy company. You give it this big terminal value. You discount it all back. You come up with a value of $1 billion for the company. That's your DCF value of this distressed company. Is that value that you come up with, assuming you've made realistic assumptions about margins changing over time and debt ratios changing over time, is that value that you come up with as a DCF value a fair value, too high a number, or too low a number for the actual value of the company? When I said it's a distressed company with a lot of debt, what's the thing that's hanging over this company? What are you worried about? That company will not make it, right? When you do a DCF, what are you assuming the company will do? Survive, make it as a going concern. You valued it as a going concern, you come up with $1 billion, right? Do you see where I'm going to go next? If there's an 80% chance you will not make it through the next 2 years, there's no place in my DCF to reflect it. One of the things we're going to talk about today is how to bring in that. So those of you valuing money-losing companies or distressed companies, there's an additional step you need to take before you put a final value for the company. And I would say the same thing. If you're worried about nationalization risk, you value a Venezuelan company, you get a DCF value, that's the value of the company as a going concern. But I say, you know what? There's a 60% chance the Venezuelan government will nationalize your company and give you half of book value. You've got to bring that into what you're willing to pay for the company. So we're going to examine all of those, but before I do that, I'm going to kind of deal with the particular set of questions that have been coming up the last 2 days, and I don't mean to pick on people, but I think these are kind of general questions that might help everybody. Go ahead.
I had a question on the distressed company. Wouldn't that be reflected in the cost of capital?
That's a great question, because usually you're told cost of capital is where you show risk, right? A riskier company should have higher cost of capital. Where in the cost of capital am I going to show it? Say I have a really high cost of debt, right? Let's say it's 15%, even 18%, D-level debt. You know what the problem is? That is going to discount the cash flows, but you're still getting the cash flows in perpetuity because you use a higher discount rate and you allow the company to keep going forever. You're still valuing it as a going concern. The risk you're worried about is what I call truncation risk. Unfortunately, discount rates were designed for what's called continuous risk. They're designed to capture the fact that you could be horribly wrong about year 10 cash flows. But the risk I'm worried about is there might be no year 10. So I'm going to argue that with distressed companies, trying to adjust the discount rate will only frustrate you because you can do only so much. Your discount rate actually goes to infinity, right? When your company just stops existing. It's difficult to get the discount rates to carry the weight you will have to get them to carry. There is a chance you could double count, and I'll talk about what I do to prevent the double counting. But I think adjusting the discount rate alone will not do enough for you. Okay? So I'm going to take a bunch of questions I've been asked about your companies and kind of put them together. One is somebody earlier today came in and they had a problem because they were using a 10Q. I don't see the person in the room. Oh, there you are. What's your name? MJ? Okay. MJ came in and he said, I'm valuing a company. I'm using a 10Q and I can't find lease commitments for my company in the 10Q. And the reason is actually very simple. Accounting standards require that you reveal your lease commitments of your US company, but only in the 10K. So here's the question he was asking. It's a very logical question. He says, I'm getting most of my operating income from the 10Q. I can't find lease information in the 10Q. The lease information is the 10K. Am I not being inconsistent in taking some of my information from the 10Q and some of it from the 10K? And then I asked him, where did you get your risk-free rate? And he said, from the T-bond rate, and it was in the paper yesterday. And I said, where do you get the market price? And he said, I looked up the price yesterday. So I said, it's not just this that's inconsistent. Your market data is updated every minute of every day. Some of your data comes from 10Qs, some from 10Ks. It sounds like you're being incredibly inconsistent, right? Here's my response. You're actually being consistent. Here's my definition of consistency. Are you using the most updated information you can find for each input? That's what you're doing, right? Market data, you can look it up right now. Accounting data you have to get from the last financial statement, and some accounting data might get updated only once a year. You're saying, but that's not fair. If you're an investor today in a company, That's what you face, right? Some information gets updated constantly. Some gets updated less frequently. All you can do is live in the world you're in, not the world you wished you were in. The world you're in, data gets updated at different points in time. Just view it as being consistent from that perspective. Staying on the topic of leases, those of you valuing non-US companies have noticed a very unpleasant practice. I think it's unpleasant that they have. You know how US companies have year 1, year 2, year 3, year 4, year 5, and then beyond? European companies will do this absolutely stupid thing. They do years 1 through 2 and years 3 to 5. Come on. You don't know what 3, 4, and 5 are, but because they don't have to, they'll actually bundle it up. So let's say they say, years 1 and 2, my lease commitment is 100 million. Years 3 to 5, it's 120 million. And of course, that throws you off because you look at the spreadsheet, it asks for year 1, year 2. Do the logical thing. Just take the first 2, divide by 2, put 50 in each year. Take the next 3, divide by 3, put 40. You say, am I allowed to do that? Remember what I said, you're allowed to do pretty much anything you want. In this case, this is as good an assumption as any I'm going to come up with. I would have suggested the same thing to you. But you don't need me to make that judgment. So if you find that information is kind of tough to work with, that's what you have to do. Now let's get closer to home. Fernando, tell me what the problem you told me you had in your evaluation was.
When I was trying to find the reinvestment rate,
it was a negative number, right? So basically, Fernando said, look, when I took my company, remember the definition of reinvestment is capex minus depreciation plus change in working capital. That number can be negative for companies that have depreciation that exceeds capex or a big drop in working capital, right? Working capital decreases. Remember that is the reinvestment rate for last year. This is something it's very difficult to let go of, right? All the numbers you're getting by doing all these calculations are numbers for last year. Why am I saying that? Because what is the value based on? The future, right? I'm going to give you a fresh slate and say, tell me what this company will do in the future. There is no number that comes from the past that you're bound to. So let's say you look at the return on capital last year and say, it was 31%. You can look at your company and say, hey, the business has changed. Healthcare is a different business. I'm going to use a 12% return on capital. Do you see where I'm going to go with the reinvestment rate? Your reinvestment rate last year was negative. If this company continues to have a negative reinvestment rate, I can do a valuation, but with a negative reinvestment rate, what should I expect to see as growth in your company? A declining company. So if you feel it's a declining company, there's nothing wrong with using a negative reinvestment rate. But if you feel this is a growing company, here's what I would do. Take the growth, take your return on capital, and reverse engineer what reinvestment rate. So basically, you have 3 variables in this equation. You need 2 of them. Normally, we take reinvestment rate and return on capital to get the growth rate. In your case, you'll have to get the growth rate and return on capital and back into a reinvestment rate. You reacquire the power in the process. And finally, I'm going to pick on Anna. She came in, she's valuing Salesforce. She's having some issues. And the issues were really about the fact this is a young growth company. You look at last year's numbers, you can get numbers, but everything is in the future. Their revenues are growing, their margins are changing, their reinvestment could be any number. And I think she was just looking for, hey, is it okay for me to make estimates? Because you're so caught up in last year's numbers, you want to build off last year's numbers, that you feel that if you come up with your own estimates, that this is more dangerous. That's a psychological issue, right? Because ultimately, all companies, it's about the future. The only difference between Coca-Cola and his sales force is what? With Coca-Cola, I have more crutches. I can use the historical data. I can build off the historical data. With Salesforce, I have fewer crutches. And that makes us uncomfortable. And that's what I was talking about with Amazon. The 2000 valuation I left you with. This valuation, and this is probably a good point to kind of go back to that page that I left you. In this valuation, every number that I was estimating was based on the future. In fact, there are very few inputs in valuing Amazon where I've looked at historical data. The sales to capital ratio came from looking at industry averages. The target margin came from looking at retail firms. The revenue growth number, and I'll have to talk about it, came from nowhere, right? I just made up 42%. The cost of capital came from looking at other companies in the business. There's very little in this valuation that is Amazon specific. I remember the valuation of Uber that I talked about in the stories, and the reason I was able to value Uber, even though they're a private company with only rumored data, is because I'm not dependent on historical data. It's everything's about the future. I think I can value a company if you describe what the company is, even if you don't give me the financials, because so much of the information for young startups comes from looking at the market, looking at the competition, looking at the business. So let's take this valuation, and I'm going to draw a series of lessons about valuing young companies like Salesforce, like Amazon in 2000, like Uber, that hopefully if you're valuing a young company, you might find useful in your valuation. Here's the first one. Remember we talked about how regression betas are so dangerous in evaluation, using one regression beta? And we talked about how noisy it is. This is standard error. That goes in spades with the young company. And let me explain why. This is the beta page for Amazon. If you can read it to the side. Take a look. The beta is, raw beta is 2.23. You think, this is good. I have a regression beta for Amazon. Before you get too excited, the standard error of that beta is how much? 0.50. Which means the true beta for Amazon can be anywhere from 1.23 to 3.23. A regression beta for a young company like Amazon, a young company like GoPro, is going to be pretty close to useless. Because you're catching the company just as it's changing. There's incredible amounts of noise in the regression. So if you're using regression betas for a mature company, you might get away with it. Don't even try to do it with a young growth company. Okay. Second, once you get that beta, you feed it in. I used a beta 1.60 to get started. I used a bottom-up beta of online retailers to get started. Don't just leave it at 1.6. As your company changes, your beta should change, your cost of equity should change, your cost of capital should change, because your company is changing. So on discount rates, everything we said about mature companies just gets magnified with young companies. But you still have to get cost of capital going forward. Finally, don't get too fixated on the cost of capital. If you think about the inputs into your valuation, from most important to least important, in lots of young company valuations, the cost of capital is the least important input in your valuation. It's not the most important. In my Snap valuation, you know how much time I spent on the cost of capital? I think 3 minutes towards the very end. Because my value of Snap is driven by revenues and margins a lot more than the cost of capital. In fact, I'll let you in on a secret on how I got the cost of capital for Snap. I didn't compute a beta and a risk premium and a risk-free rate and a debt ratio and a cost of debt. Everything I told you in class, I ignored. Partly because it's an IPO. There's no, I can't do any of the stuff. And partly because it's an exercise that's going to suck up my time that I would rather spend on getting margins and revenue growth. So you know how I came up with 11% cost of capital? I have a distribution of cost of capital for all US companies. And if you want, I'll send you that distribution with my email today. Basically, it breaks the cost of capital for US companies down into 10 deciles. The lower, I think the 10th decile of cost of capital for US companies is 5.6%. So 5.6% is a really low cost of capital. The 90th decile is about 9%. Think about that, 9%. The median is about 7.2%. The 95th percentile is about 11%. So I said, Snap, it's a risky company, and I don't think anybody would contest it. I'm going to give it the 95th percentile cost of capital, and I'll come back and worry about it later because I know that finessing this is not going to change my valuation very much. So when you think about cost of capital, remember that the room to run is fairly limited. So if in your DCF, you're seeing cost of capital of 17, 18, 20, 22%, something is wrong. Either your entire company's operations are in Venezuela, in which case you could end up with a 20% cost of capital, or some input you're using doesn't really make sense. Because when you get up to the 12, 13, 14, you're looking at the very highest cost of capital for a typical US company. So that's the first lesson. Any questions on that? Okay. Second, let me talk a little bit about my compounded revenue growth number. I used a 42% compounded revenue growth, right? Let me back up. When you look at a young company and you try to forecast revenues in year 1, year 2, year 3, normally we work sequentially, right? You know what I mean by sequentially? You do year 1 first, then you do year 2, then you do year 3, because that's how we're taught to do valuation. With a young company, that is going to drive you crazy, because by the time you get to year 3, you're so completely out to lunch about what's happening that you say, how the hell would I know? So here's what I'm going to do, and this is going to sound strange when I first describe it. Because I'm so uncertain about year 1, 2, and 3, I jump to year 11. Saying, how come you're so certain about it? I'm not certain about year 11, but I talked a little bit in the last class about when you value young companies, you need a vision of what you think this company will look like as a successful company. So I'll put myself back in January 2000 when Amazon was this tiny money-losing company. And at that time, I liked Amazon as a company. I liked their management. I thought they would succeed as a retail company. So ask me how come I didn't see that they were going to succeed in cloud computing. If I'd seen that coming in 2000, I'd be a bloody genius. I had no idea that they were going to go into all these. But in 2000, I said they're going to succeed in retailing. So here's what I did to come up with the revenue growth. I took the 10 largest retailers in 2000, none of which were online. So companies like Walmart, Target, Costco, Gap. I projected out what the revenues for these companies would be 10 years out, which isn't difficult because these were mature companies. I had a list of the 10 most successful retail companies in 2010. I took a look at that list and I say, given what I know about Amazon, what I think about Amazon, where on this list would I put this company? And I put them 6th on the list. I didn't see them as a Walmart. I didn't see them as a... So essentially, I said they're going to be about the middle of that list. The 6th largest company on that list would have had revenues of about 40 billion. You see where I'm going to go next? I'm at $1 billion. I need to get to 40 billion. What am I going to do over the next 10 years? Build myself up. And the only simple rule I followed was as I get larger, my growth rates have to get smaller. Here's a final question. Why 150, 100, 75, 50? I just made them up. You think that is so simplistic? This is supposed to be scientific. There's nothing scientific about it. If you fought me on year 1's growth rate and say, I think it's going to be 163.76%, you know what I'm going to do? I'm going to give it to you. You want year 2? You can have it too. You give me the starting and ending numbers for a young growth company. I control the valuation. Young company values are driven by the end game, not by that early game or middle game. In this case, my end game is I see them as the 6th largest retail company in the world. Now with Amazon, that was relatively simple because I saw them as a retail company. With Salesforce, it's more difficult because you have to think about what kind of business are they in. Are they in business software, in which case you can look at the revenues of an Oracle or an SAP as your end game. So that's what I think a successful company will look like. But you need a vision for a young company to value it. Yes?
So you have your model.
I have my story, and then the model follows, right?
You have the model on...
I'm going to replace it. I have a story, and the model follows.
You have your example number 6 company in the market.
Yeah.
So your valuation goes 10 years into the future. Do I have to grow this number 6 company 10 years?
Oh, you're saying that original list that I had? Yeah, I did project it out. But remember, these are all mature retail companies, so their growth rates were 5, 6, 7% at that time. So what I did was I took Walmart's 2000 revenues. And this wasn't you're not talking about young growth companies. These are the biggest companies that kind of track to the growth. So even if you don't have the individual companies, you have the growth in the overall market, just apply that growth rate to each company. Because you want to get a rough sense of the inflation-adjusted big value numbers. So if you're really caught up and I can't do a 10-year forecast, just take this year's number, apply an inflation rate at least for 10 years to get what a 6th largest company will look like 10 years from now. Any other questions? Okay. So I have my small half my problem has gone away, right? Now I've made my small revenues into big revenues. And I've given you a window at least into how unsophisticated my approach was. That's why I find it almost laughable when a company like Snap will reveal its first earnings report in like 2 months and people will freak out. Oh, that looks horrible. I'm going to sell off the company. Reacting to that early earnings report is, I think, way too early in the process because unless your story is changing, your value should not change. Let's talk about margins. The existing margin for Amazon is minus 36.71%. I want to get them to plus 10%. The target margin came from looking at retailers. Again, I took that approach, and I described this earlier when we talked about, I think it was Tesla in the early growth, where I took half the distance to my goal every year. Why half the distance? Why not? You could use a quarter of the distance, in which case you will lose more money for a longer period. You know what I mean by half the distance? My margin right now is minus 36.7. I want to get to plus 10. The distance is 46.7. I took half the distance, 23.35%. That puts me at minus 13.35%. I'm at minus 13. I want to get to plus 10. I take the distance, divide by 2. I push myself to half the distance. So each year I'm moving towards my steady state. And if you make it a quarter of the distance, you're going to still end up at 10%, but you're going to lose more money in the earlier years. It's the simplest device I have for you to disagree with me. So if you disagree with me about how easily it's going to become profitable, you can change that number. So my losses become profits. There's one little final component with money-losing companies. It's a bit of a pain in the neck, but you got to keep track of anyway. So in the first 2 years, Amazon is losing money, right? So it pays no taxes, obviously. In year 3, it's making money, but it's still paying no taxes. Why is that? Because losses carried forward. So one of the things I have to keep track of with money-losing companies is losses that I make over time will add on to my net operating loss. And when I start to make profits initially, I'm going to use that NOL to cover those profits. So I can go years 3, 4, and 5 without paying taxes before the taxes kick in. So I've got my revenues go from small to large. My losses have become profits. Let's keep moving. As I do this, I have to constantly remind myself that scaling up is hard to do. That becoming a bigger firm, keeping those growth rates becomes much more difficult to sustain, whether it's 20 or 30%. So that's part of the reason I brought the growth rate down. I'm going to show you a graph to illustrate how difficult scaling up is. This is actually from a study that looked at companies that have just gone public, companies like Snap, and compared the revenue growth rate at that company to the revenue growth rate of the sector to which this IPO belongs. So if you're an online advertising company, I compare your growth rate to the growth rate of the sector. So here's the obvious that they found. Young companies that have just gone public tend to have higher revenue growth by about 15% than the rest of the sector. You're saying, that's why I buy growth companies. You track these companies 1 year after the IPO, on average their growth rate is now only 7% higher than the sector. 2 years later, or 3 years later, it's 3% higher than the sector. By the time you get to year 5 years after the IPO, it's tough to tell these companies apart from the rest of the sector. What does this mean? If you're valuing a young growth company, it's so easy to get caught up in that history and say, oh, this is a great growth company. It can keep doing this for 15 years. So when I do 10 years, I'm already pushing the envelope as to how long growth typically lasts at a growth company. The median growth period for a high growth company in the US is 3 years. So 10 years pretty much pushes me to that outer end of the envelope. Okay. So if you're tempted to make my 10 years of growth into 15, I won't stop you, but you better have a really good story about your company, about why this is the kind of company that's going to be able to scale up more than 99% of other companies. And that lesson about reinvestment we talked about in the context of growth, don't forget it just because you're looking at a young growth company. And as I said, this is the input that I got stuck on the longest in valuing Amazon. Because you try any of the traditional route, like return on capital times reinvestment rate, you're going to hit a dead end. That equation works only if you have mature companies with stable margins. If your margins are changing, that equation will break down. So in this case, because I'm losing money and my margins are changing, here's what I did. I took the change in revenues each year. I divided by 3, which was my sales to capital ratio. I came up with my reinvestment each year. That reinvestment actually adds to my invested capital. So I kept track of my invested capital each year. And notice over time, my invested capital, this is the book value of capital in my company, increases from less than $500 million to almost $13.1 billion. You say, why would you care? Implicit in my valuation is my assumptions about future return on capital. In fact, if I divide my after-tax operating income in year 10 by the invested capital in year 10, my return on capital for Amazon was about 20.39%. You're saying, so what? I had to take a look at that number and decide whether I was okay with that number. Was that consistent with the story that I was telling about Amazon? And in early 2000 it was, because these were the days when risk-free rates were 6.5%. The average return on capital in the retail sector was 18 or 19%. I was okay with 20.39% in year 10. You know what I wouldn't have been okay with? If that return on capital had been 200.39%. What's my own spreadsheet telling me? You're reinvesting too little. And how do I fix it? I lower the sales to capital ratio. In fact, if you look at the bottom of my Ginzu spreadsheets, I actually give you the return on capital that you're assuming for your company by year. And one of the reasons I do it is for you to take a look at what your reinvestment is doing to your company. So you get the value of equity. You get ready to divide by the number of shares. Two things you have to consider. One is that many of these companies, as they grow, will issue more shares. You know that's going to happen, right? Those negative free cash flows will create more shares. And as I said, don't worry about it. That's already incorporated into your valuation because your discounted cash flow value is pushed out by the negative cash flow. So don't double count by bringing in the discounted cash flow value and also adjusting the number of shares for new shares issued. But once you get the DCF value, you have to think about what to do next. You have to think about dividing by the shares. But the dilution is taken care of already. The dilution from both the options that might be exercised and the dilution from having to issue new shares. And that's the good news. You don't have to adjust the number of shares for future dilution because it's already factored in. Okay. Is everybody comfortable what I mean by already factored in? The Amazon case, if you look at those negative cash flows for the first 6 years, the present value of those negative cash flows is actually minus $6 billion. So my value for Amazon of $14.9 billion has already been lowered by $6 billion for expected negative future cash flows. That's your dilution effect already factored in. You don't have to adjust the number of shares for the share count. Now let's talk about the survival issue. We talked about it in the context of distressed companies. But you know that 65% of startups never make it. They just fail. Right? That's the nature of startups. That's why VCs charge 35-40% return. So what VCs try to do is they say, look, most of the companies I invest in, I'm not going to make money on. So the companies that I invest in, I'm going to demand this really high rate of return to make up for the fact that the companies will not make it. And they're trying to use the discount rate to adjust for failure. And it's a terrible way to do it because it mixes up risk with survival risk, with cash flow risk. So here's what you can do instead. This is actually from the US government actually has this very interesting database of all startups by sector. And they track how many of these startups actually make it through year 1, year 2, year 3, year 4, year 5, year 6, year 7. So I'll give you overall what the numbers look like. For every 100 companies that get started up, 1 year in, 20% of those companies have failed. 7 years in, almost 70% of those companies are gone. So that is a signal of how much failure there is in young companies. And when you do a DCF of a company, what are you assuming? It's going to survive and it's going to make it. Already you can see that if I do a pure DCF of a startup using regular cost of capital, I'm going to overvalue the company because I'm missing the 70% of the time when the company has no value. If you scan my simple Ginzu spreadsheet, towards the end I ask you a question, which is, in this valuation, I'm assuming that your company will never fail. Do you want to change that assumption? And if you say no, then I just do the DCF and say that's your value per share. But if you say yes, then I ask you a follow-up question. Does anybody remember what that follow-up question asks you? What's your chance that your company will not make it? And if it's a really young startup, what am I giving you a chance to put in there? 60, 70%. And then I ask you, if your company doesn't make it, what will your equity be worth? And in most cases, the answer is, if it's a startup, it's going to be 0. What are you going to sell? So what I'll then do is do your DCF value and multiply it by 0.3, then take 0 and multiply by 0.7, and your value per share is going to be far lower than you'd have got from the pure DCF. It's the simplest way. I'm basically, if you heard of decision trees, you might have seen this in one of your other classes. I'm introducing a decision tree front on your DCF saying, if your company is likely to fail, that's the best way to bring it in. So I finished this Amazon valuation. And do you remember what the value I got was? $35 per share, right? The stock was trading at 84. First question somebody asked me was, am I selling short? If you remember my answer to her from the end of the last class, I said, not in this lifetime, because I can't sell short for 5 years. And then I get a very plaintive question. This is the last question in the entire session. Must have been from somebody who actually owned Amazon as a stock. And she said, is it possible that Amazon is worth $84 per share? What's the answer to that question? Possible is such a weak word. The Yankees could go 162-0 this year. It's possible. It's implausible and improbable. Nobody goes 162 games. It's possible. Of course it's possible. In fact, in my valuation, I'll tell you what has to happen for it to be worth $84 per share. My two big assumptions are revenue growth and margins, right? If I have much higher revenue growth or much higher margins, my value per share will be higher. So this is something I actually do at the end of most of my valuations. I try to work out what combination of assumptions I would need to get to my price per share. We talked a little bit about this earlier when we talked about changing growth. Here I've changed both growth and margins. See these shaded areas? You know why they're shaded? Because they're above the market price of 84. So what does Amazon have to do to be worth $84 per share? It's got to grow like Walmart and have margins like Ann Taylor. If you think you can pull that off, that's a pretty tough combination. Of course you should buy Amazon. So if your test for a stock is it possible the stock is worth whatever it's trading for? The answer for most stocks, in fact for every stock, has to be yes. What's the question you really should be asking when you invest? Is it plausible? Is it probable? And that's why I made such a big deal about pushing your story through those, because you can't invest based on possibilities. Which brings me to my final lesson. And this is a lesson I'm going to emphasize with young companies, but it really applies for any company. So I valued Amazon. I made my best judgments with the numbers I had, and I came up with this $35 per share. There's one thing I can guarantee you, and this is going to be true every single time you value a company. You're going to be wrong 100% of the time. It's pretty bad, right? You're going to be wrong 100% of the time. Why? Because you're not God. If you're working under that misconception that you are in fact God, then good luck to you. But you don't control the future. All kinds of things can happen. You're going to be wrong 100% of the time, and you have to be okay with it. You know what I mean by okay with it? You value your company, you turn in your DCF value, the stock price drops on Monday. You can't start beating yourself with a whip saying, oh my God, I did the wrong things. Let it go. And here's the consolation prize. You don't have to be right to make money. You just have to be less wrong than everyone else. Remind yourself of that basic truth. You just have to be less wrong. So as you go through this process, you're going to constantly, at every number, say, how do I know this is right? You don't. You're wrong. Actually, start off with this. I'm going to be wrong. It's okay. Just put the number in, value the company. You're going to be wrong. But here's what I want you to keep track of. If you decide to do this on company after company, and you consistently are wrong, that's what's to be expected. But if you're consistently wrong in one direction, you know what I mean by that? You consistently find that your cash flows are higher, or your value is higher than the actual price, stock after stock, then you have a problem. Why? When you're consistently wrong in one direction, what does it tell you? That there's some bias in this process that's crept into your estimation. That's when you have to go back and take a look at how do I value companies, what do I do with my estimates, because you can live with mistakes, but you can't live with bias. Mistakes average out, bias doesn't. So this is played out with Amazon. As I said, the first time I valued Amazon was in 1998. And I valued Amazon every single time since, every single year since. I've bought Amazon 4 times. I've sold Amazon 4 times, which kind of tells you where I am with Amazon right now. But I'll take you through just the 4 years right after 2000. In 2000, when I valued Amazon, I found it to be significantly overvalued, right? $35 versus $84. And I said, I'm not selling short. 1 year later, I revalued Amazon. My value went from 35 to 25. You're saying, that's terrible, your value changed that much? Look at what happened to the stock price. It went from 84 to 11. The stock went from being massively overvalued to massively undervalued. So in 2001, if I'd shown you the valuation, what's the question you'd have asked at the end of the valuation? Did I buy it? And I did. I held through 2002. Why did I hold through 2002? Because I'd revalued Amazon. It still looked. I sold in 2003 because the stock had gone back. You can see why the 4. I'll also make a confession. I haven't held Amazon since 2001 because to me the stock has looked overvalued. And that's the downside of intrinsic value investing. The stock is actually up 200%. You wouldn't have touched it since 2001 because the price keeps going up and up and up beyond my valuation. You're saying, shouldn't I adjust my investing to reflect that? You got to decide whether you came to play this game. I came to play the value game, and based on the value game, Amazon no longer looks like a stock that should be in my portfolio at today's prices. But if the price drops to $250 next year, it's going to be back in my portfolio. There are stocks I track every year. Stocks like Tesla. I'd like to own Tesla, not at today's price. I'd like to own Salesforce, but not at today's price. Does it mean I won't value them? No, I'll keep valuing them because you never know what the market will do. When you look at how the market behaves with these stocks, it behaves like a manic depressive. It's bipolar. It just basically shoots in one direction or the other, and you're trying to take advantage of that bipolarity. Any questions on valuing young companies? So I did something that is usually very humbling. And I would suggest at some point in time, this will take a while for you to be able to do. You try this. Wait about 10 years from now. And this is what I want you to do. 10 years from now, I'd like you to take the companies you're valuing and look at the actual numbers over the 10 years against what you forecast for the company. Any delusions you might have had about being a guru or an expert will dissipate in a second. So this is actually a great exercise to bring yourself down to earth. So I do this every time I visit CNBC because I hate those the valuation. They try to use all kinds of things just to set you up, to knock you down. So as soon as I come back, I look at my... this table usually brings me down. Those were my forecasts from early 2000. So the revenues and margins. And there is the actual number. So let's take the revenues. I projected out revenues of $51.5 billion in 2014. The actual revenues came in at $85 billion. So clearly underestimated how much revenue Amazon could have had. My operating income projected out was that they would make $5,146 million. Their actual operating income was $97 million. So I massively overestimated margins. I underestimated revenue growth. What have I learned? I called Amazon my field of dreams company. Basically, it's a company where Jeff Bezos has told investors, if I build it, they will come. If you build what? The revenues, the profits will eventually come. Amazon is, to me, the perfect example of how markets have patience with companies that have a consistent story. What I mean by a consistent story is, there's actually this letter that Jeff Bezos sent his investors in Amazon in 1997. You can find this online. Go read the letter. It's actually one of the most amazing documents I've read, written by a CEO, because he laid out the plan that he had for Amazon. He said, we're going to focus on building revenues first. So don't even look at our profits. And once we get those revenues, we'll worry about profits. So he stayed with that story. And more than that, everything he's done is consistent with that story, right? How many of you own Amazon Prime? Right? What do you pay for it? You don't own it?
I use trial.
You use what?
Student trial.
Student trial, at some point in time, you'll stop being a student. So what do you think you'll pay once you... Does anybody know what the annual... It's $99, right? On Amazon Prime, one of the most dangerous things you can own. It's one-click buying, right? And sometimes late at night, you're really tired, you're a bit depressed, you go click, 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 you know. You're buying all kinds of things. I add up sometimes the amount of money my family, because with 6 of us, we're clicking away like crazy. I can see my daughter clicking. I can tell how depressed she is by how much stuff she's ordering on Amazon and my account. You know what it costs Amazon to service a Prime member? You can actually find it in the 10K, they give you the cost of... Because what do you get in return for Prime? Free shipping. And if you think about it, the free shipping adds up. It costs them $390 a year to service every Prime member. So why do they do it? If you build it, they will come. So basically, as a Prime member, they're saying, if you keep buying, I'll get to you one day. It's like that witch in Snow White, or whichever it is. I'll get to you, my pretty kind of thing. I'm going to get to you one day. You know what that day will be? Is when we're all so addicted to Prime, and there's no other brick and mortar retail store around you, all of a sudden you're going to get a notice in the mail saying your prime went up from 99 to 9,999. You're saying, I'm going to stop it then, right there. Where are you going to go? What if there's no Walmart or Target around? That's the conspiratorial view of Amazon, is they want to control the world and charge you $9,999 for Prime. Okay? Maybe that's your valuation story for Amazon. But because he's been so consistent, markets have cut them slack. Slack in what sense? Normally a company that's 20 years old that's still losing money or making so little money gets punished, right? Amazon's market cap keeps going up and up because his story has actually been, if we build it, they will come. And because he's been consistent, markets have been okay with it. The most recent earnings report, Amazon's stock price dropped 6% after the earnings report came out. You know why? Because finally, the revenue growth came in lower than expected, which is uncommon, and they reported 4 times as much profits as expected. They're coming, I guess. And when they're coming, investors are actually disappointed. They were hoping for... This is what happens when investor storylines miss the they will come, right? They kept saying, this is a revenue growth story. This is going to happen. That pivoting to profits is going to start to happen. Part of it is coming from the cloud computing business that they have, but part of it is even coming from within the retail business. Okay? So it's actually a fascinating story that you can see for this company kind of play out and how that story drives the value of the company. So there's my October 2014 Field of Dreams valuation of Amazon. Remember I said every company has a story. The story I'm telling for Amazon is it's a Field of Dreams company. Basically that they're going to go after high revenue growth. Their margins will stay low. So basically the high revenue growth reflects their focus on revenues. The margins will stay low for the near term as they give away stuff like the Kindle and Prime and try to get their revenues. And eventually the margins build up. The value that I got for Amazon based on the Field of Dreams story, and you can see every part of the story reflected in the numbers, is basically $81 billion. Stock's actually trading at 600, was trading at what, when I did this, 287, it's since gone up to 400, 500, 600. Is there a story you can tell for Amazon to be actually worth 600? Yes, I think for it to be worth a lot more, I've got to tell a different story. The margins I went towards in my previous valuation were the average margins of the sector. Here's the story you would need to tell for Amazon to be worth a lot more. They're going to go after revenue growth, and once they get the revenue growth, they're going to start to push up margins, not to the industry average, because they're going to destroy the rest of the industry. It's some number much higher. This is the 9,999 prime. And you know what? It sounds crazy, but it terrifies me when I see Bed Bath & Beyond shut down and brick and mortar retail, because this is truly a world where at some point in time there are some things you might be able to buy only on Amazon. And at that point you got to ask, what do I do about higher prices then? It's not like you're going to be able to go to the local store and buy stuff. So this is one potential story where the value is much higher. There's another story that we're an Amazon investor should really terrify you. Is Jeff Bezos a pretty rich guy now? He's in his 50s, he owns the Washington Post. He's got everything he needs, right? He's got a big house, he's got lots of savings. What if his end game for Amazon is not to make money but to change the world? Could be, right? Maybe he doesn't care about ever making money, he just wants to destroy the retail business and keep making nothing. Then what's the value per share going to go to? My revenues will keep climbing, my margins will stay at like 1.5%, the value per share will drop to about $33 per share, and you're going to be sitting there 10 years from now saying, what the hell did I do? So you got a Field of Dreams story, you got the world dominator, you got this is Jeff Bezos' charity to the world. You take your pick, you can see how this is a company where there's always going to be massive disagreement among investors about what the company is worth. Okay? So let's move to a less fun segment of the life cycle. Let's say you're looking at mature companies. Generally speaking, what makes mature companies easy to value is they've been doing the same thing for a long time, right? The business model is set, they do things the same way. That's good news, right, if you're doing valuation. But can you sometimes do the same thing for a long time, but it's the wrong thing to be doing? Can you get into bad habits? Sure. And with mature companies, sometimes mature companies get into bad habits. Bad habits in what sense? They sell stuff that doesn't make them money, but they've forgotten that they even sell the stuff anymore. They do things the way they've always done, but they're not working anymore. So sometimes mature companies are forced to change the way they behave. You say, what do I do about these companies? You're saying, so what? When you think about those 4 questions, what are the cash flows? What's the value of growth? How risky is this company? When will I be a mature company? If you think about a typical mature company, these questions are easy to answer because you look at the past. But if a mature company has decided to change the way it does business, each question becomes more difficult to answer because if you look at the past, you get a reflection of their past business model. But if you look at the future, because they're going to run the company differently, you can get very different numbers. So let's instead of being abstract, let's take an example. I'm going to value a company called Hormel Foods. You heard of this company? They have one very famous product, one of the most disgusting things ever sold as food. Know what it is? It's meat that comes in a can. Spam. Perhaps the most it's like ham that comes in a can that you can keep for 100 years. Can you imagine? Meat that lasts, God only knows what they've added to it. You see, why would somebody invent something like this? You know how Spam was invented? Or why? After the Second World War, U.S. Army was bringing its soldiers back from the Asian front, from Japan. And in those days, the planes couldn't make it all the way back from Japan to the U.S., so they stopped in Hawaii. Those days, Hawaii was not the big tourist state it is now. So you have the U.S. Army, tens of thousands of hungry soldiers landing in Hawaii, and there was no food. How much pineapple can you keep eating, right? So the U.S. Army put out a requisition to food companies saying, we want you to come up with some food that we can serve to hundreds of soldiers that you can store. There's no refrigeration. And Hormel came up with Spam. That's why in Hawaii, you go to one of those bookstores, they actually have Spam cookbooks. They do things with Spam you don't even want to know what they do. Fried rice with Spam, Spam teriyaki. You name it, Spam is in there, right? Spam pie, Spam this, Spam that. It's disgusting no matter how you dress it up. But this is a very old U.S. food company. And many very old U.S. food companies started off as family businesses. They've been around forever. Many of them are Pennsylvania-based, don't ask me why. And they run the same way over and over by very conservative management. So I did a valuation of Hormel with the existing management in place. And the existing management is extremely conservative. Conservative in what sense? They don't reinvest very much money, which keeps their growth rate low. Why don't they reinvest very much money? They think the world actually ends on the U.S. borders. They don't look outside saying global stuff, we don't do that. Even Hawaii, they were a little reluctant. Do we have to cross water? That sounds dangerous. So it's a very conservative company. It doesn't reinvest very much. Growth is low. They also hate to borrow money. Why? Because they're a very conservative company. They have a debt ratio of 10% and their cost of capital reflects it. So I valued them with the existing management, low growth and a high cost of capital. The value per share that I got was $31.91. And I asked a follow-up question. What if someone else ran the company? Someone who's not as conservative. The first thing that struck me that would happen is this new management that comes in will be more aggressive in reinvesting. They'll have a higher reinvestment rate. I used a higher reinvestment rate, which pushes up the growth rate. And they will also be more willing to borrow money. So I didn't go crazy and do a leverage buyout or something. I increased the debt ratio from 10% to 20%. What I got, 10%, yeah, 10% to 20%. I got a lower cost of capital and a higher growth rate. The value per share that I got for Hormel with the new management in place was $37.80. So I have two values, right? I have a $31.91. I have a $37.80. Let's say you're an investor looking at Hormel. The stock is trading at 33. Would you buy the stock? It is higher than the $31.91, so it looks like the stock is overpriced, but it's lower than the $37.80, right? So what's the final judgment you have to make? What is the chance that the company will change? And how do you decide that? You have to look whether who owns the stock. So I actually went and looked at who the top stockholders in the company were. The biggest stockholder in Hormel was the Hormel Foundation. That was actually the family's shares put into a foundation. They owned about 25% of the stock. You're saying this is good. If they want change, everything's going to happen. So I went and looked at who ran the Hormel Foundation. And the chair of the Hormel Foundation was the CEO of Hormel. We have a problem. If you're the chair of the foundation that owns 25% and change has to come to your company by replacing you, it's unlikely to happen. So I estimated there was only a 10% chance of change, because even with foundations like that, change sometimes comes, like it did in Hershey's. I attached a 10% likelihood of change, 90% that wouldn't change. My expected value for Hormel Foods was a weighted average of the two numbers. And that weighted average was about 3250 weighted. So it's 90% times that plus 10% times this, which is 3250. So the stock's trading at 33. I'm still not going to buy the stock. So when you have companies in transition, you sometimes have to do two valuations of the company, one with the management in place and one with change in place, and take a weighted average. A few points about that transitional point. One is, whenever you read about companies like Hormel that are trying to change themselves, one of the things they talk about is cutting costs. You'll see a big Wall Street Journal headline. Hormel Foundation announces plans to cut costs by $3 billion. It's easy to put out a headline. So one of the things that's interesting to follow up on is how many companies that promise cost cuts actually deliver cost cuts. I might have mentioned the McKinsey Quarterly before in this class, but this is actually a free magazine you can go online and subscribe to. That's published by McKinsey, the consulting firm. It does great work. And one of the things they looked at was what percentage of companies that go out and tell you they cut costs actually do. And they looked at the things that drive whether a company actually follows through. And there's no surprise. Many of the companies, the cost cuts don't come through unless there's clearly everybody in the top management is in support of it. If you have a split management, the cost cuts don't get through. So essentially, you look at those things, those were the things they found essentially predisposed you to believe that a cost cut would come through. All I'm saying is when you see your company announce cost cuts, don't take it at its word. Follow through, look at whether it's the kind of company where those cost cuts are going to come through. Second, it's a graph I might have shown you in a different context. Usually when you have one of these established companies that's kind of mired in low growth, your first reaction is, why don't you grow faster? Be careful what you wish for, because for growth to create value, the return on capital has to be higher than the cost of capital, right? So this is from last year. What I did was I took every publicly traded company, looked at the return on capital and cost of capital under the company, and if you look at the breakdown, about a third of companies earn well below the cost of capital, about a third earn their cost of capital, about a third earn higher than their cost of capital. What does it mean? In 2/3 of companies, asking the company to grow faster is either going to create no value or actually destroy value. So look at your company before you say, let's go for more growth. And third, when you think about what will happen to my cost of capital as my debt ratio changes. How many of you are in my corporate finance class? Okay. In my corporate finance class, you're required to do this. You're required to take your company and come up with the optimal debt ratio for the company. I'll save you the trouble of how we went about doing it. As my debt ratio changes, I want to compute the cost of capital at every debt ratio, right? So I need a cost of equity and a cost of debt at every debt ratio. To get the cost of equity at every debt ratio, here's what I do. I start with the unlevered beta, the beta from the business you're in, and as your debt ratio goes up, your beta will go up. Why? Because your beta is getting more levered, it's getting more risky, your cost of equity will go up. To get the cost of debt, if you remember we did the synthetic ratings for a company based on the interest coverage ratio. What I do at every debt ratio is compute what that synthetic rating is, and based on the synthetic rating, I come up with the cost of debt for your company at every debt ratio. No surprise, as my debt ratio goes up, my cost of debt also goes up. So both my cost of equity and my cost of debt will go up as I increase my debt ratio. If you look at the second last column, you see my cost of capital. And you can see the optimal debt ratio for Hormel is about 30% debt. That's why the cost of capital is minimized. You say, but you stopped at 20. Why? If you look at what my cost of capital is at 20%, I'm actually very close to my optimal. As I said, why should I keep pushing the debt ratio if I'm really not gaining much? So in fact, from 20 to 40%, not much happens to cost of capital, so I left them at 20%. So all I'm saying is the reason I picked 20% is not because a higher debt ratio always lowers my cost of capital. It's in this company. It does. And by moving to it, you actually increase the value of the firm. So if you have mature companies and you're working through them, sometimes you're going to look at a number and saying, that's not a very good number. But with the existing management in place, that's a number you might expect to make. Your value has to be built on that. You can always follow up and ask a second question. If somebody else ran the company, what would it be worth? And in some of these companies, you're going to get a much higher value. And that's actually useful to know as an investor, is both those values. Okay. Any questions on mature companies? Let's talk about declining companies. Okay. Let's think about it again about the 4 questions I'm going to ask you. You're a declining company. What kind of company would you be? A J.C. Penney, a Sears, so basically any of those old-time brick-and-mortar retail firms, even Macy's. So when I ask you, what are your cash flows from existing assets? You show me a pass, and what do I see? Revenues are declining over time, not increasing. Your margins are actually shrinking over time. They're not increasing. So basically, the big operating numbers are all getting more negative. And if you're an old enough company, you might also have underfunded pension obligations and stuff from the past that's kind of weighing you down. So that's the starting point. When I ask you what's the value from future growth, your reaction is what future growth? You're shutting stores down, not opening stores. So you might actually be looking at negative growth, a shrinking company, not an expanding company. It'll be the Fernando negative reinvestment rate established for the next 5 years, because that's what shutting down stores is. When I ask you how risky are you as a company, the risk is actually going to be shifting, because as you shut your business down, some parts of your business might be shut down faster, and you're using the cash from that to either pay off debt or equity. That's changing your cost of capital. And finally, when I ask you, when will you be a mature company, what's your answer to that? It's like asking a 75-year-old, when will you be middle-aged? You know what his reaction is going to be? That was 30 years ago. Why are you asking me now? You ask J.C. Penney, when will you be a mature company? Their answer, that was 18 years ago. Here, your end game might be a more morbid end game, which is, it's not a terminal value that you continue forever. It might be, when will you shut things down and just go away? Now you see why valuing these companies is so difficult. It depresses you. You feel like taking a shower after you value the company like this. Because every number is a negative number. Nothing optimistic about here. But remember, you're telling a story. The story has to reflect reality. And with a company like J.C. Penney, there is no happy ending to the story. You just have to give me the least unhappy ending you can think of. So let's think about how to deal with this. First, when you talk about dealing with decline, just get over that mindset of growth has to be positive. Why? Companies get smaller sometimes, so deal with the fact that you can have negative growth rates. In fact, my biggest concern with a declining company is not decline itself, but how managers deal with decline. Let me explain. If you're the CEO of a declining company, you're in a business, everything is shrinking down on you, and your job is to take care of my wealth. What should you be doing as a manager, CEO of a declining company? You should be shrinking the company and reflecting the reality you're in. And in my DCF, that's what I'm assuming you're doing. But what might you be tempted to do as a CEO of a declining company? What makes you a star? What made Steve Jobs the star that he was? It wasn't his first stint at Apple. You remember he came in and ran Apple, he almost destroyed the company, and then he got pushed out of the company. It was his second stint at Apple when he came back to Apple when Apple looked like it was a declining company, right? Basically late 90s. Everybody's convinced the end was near for Apple. And he turned it around. He made it this largest company in the world, most successful company in the world. So if you're the CEO of a declining company, how do you get movies made about you? You try to be the next Steve Jobs. The only problem is you're like a gambler, basically. And you can see why. Because if you put all your chips on number 22 and it pays off, you're the next Steve Jobs. And if it doesn't pay off, what do you tell me? You gave me a bad company. I had a bad hand. This is the Marissa Mayer story at Yahoo, right? Because that's basically the challenge he faced in 2012. Did anybody in their right mind actually think that people were going to start using Yahoo's search engine again? I don't even remember what it looks like anymore. There was no end, but for whatever reason, that's the load that was put on her shoulder. Turn the company around. I don't fault her for trying. I fault her for the fact that in 2013 or 14, she should have turned around and said, this can't be done. This is, basically, I'm throwing $1 billion into Tumblr, knowing fully well it's not going to come back. Tumblr was one of the companies she acquired. With a declining company, that's my biggest concern, is a CEO who feels that they can turn the company around and ends up doing things like trying to grow in bad businesses. So here's a valuation of JCPenney. As I said, there's no fun story that I can tell you about JCPenney, but here's what my story about JCPenney is. I'm going to assume that looking for the foreseeable future, all I see is shrinkage, where JCPenney is going to shut stores down. So basically, we look at the top line, what do you see? Revenue growth dropping. I'm going to assume that the stores they close will be the highest cost stores, stores where their costs are high because they're in a big urban area or they're paying more in expenses. So what's going to happen over time? I'm hoping, I'm praying that their margins will start to improve as they shut their worst stores. So that's the positive note in the story. Not to some historically high level, but to the median for the US retail sector. So over time, the company is getting smaller, their margins are reverting to the average. So by the time you look at year 10, my JCPenney is about 1/2 the size of the existing JCPenney, but it's making decent margins. As it shuts the stores down, I'm going to assume it's going to be able to get some cash flow back. Why? Because it's some valuable real estate. So as it walks away from that real estate, those cash flows now show up as a reinvestment. It's a negative reinvestment, which is really a positive cash flow. So my cash flows reflect a shrinking company. Over time, I expect my cost of capital, which right now is high because they have a really high debt ratio, to come down. I discount the cash flows back to today, including the terminal value. So by the time I get to steady state, I've created a much slimmer company that's going to earn its cost of capital. Again, I'm not asking for miracles. I discount the cash flows back. I get a value for the company right now of $5.7 billion. I subtract out the debt. And I do this with open eyes. I know that there is a very real chance that this could not happen, that they could fail. I put a 20% chance of failure in the company. Maybe you'd put a higher number. And I come up with an expected value for the operating assets of $4.4 billion. So basically, you can see that most of the story is a pretty depressing story of a shrinking company with a high chance of failure. And if they fail, they're going to get half of their book value. And that's being built into my valuation. So those of you valuing declining companies, don't be afraid to put a negative revenue growth rate. It might, in fact, be the most realistic way of valuing these companies. Now let's talk about the dark side of decline. And this is when you're declining and you have a lot of debt. And here's what you worry about. If your revenues are shrinking, your margins are getting smaller, and you have a lot of debt, it's almost like you're waiting for that car crash to happen where you're unable to make your debt payments. So here there's a very real chance you will not make it. If you do a traditional discounted cash flow valuation, I guarantee you will overvalue the company because you're valuing the company on the assumption it will make it, and there's a chance it will not. So here's what you need to do to complete your valuation. After you've done your DCF value, you have to estimate the likelihood that your company will not make it. And I'll take you through a few approaches you can use for that. And you have to ask, what will happen to my company if it doesn't make it? So I'll give you an example of a company where this was on my mind as I was doing the valuation. It's a company called Las Vegas Sands. You heard of this? It's run by a guy called Sheldon Adelson. It's a casino company, obviously. And in fact, if you've been in Singapore, the Marina Bay Sands is this big, gigantic, monstrous hotel that I'm not even sure it's a hotel. It looks like a ship on top of a building, But no, that's the nature of casino companies. They build these extravagant buildings, and they're usually run by megalomaniacs. Steve Wynn's, And I say that for a reason. Between 2000 and 2007, Las Vegas Sands grew a lot. It built new casinos in Macau, in Singapore, in Las Vegas. Now you're building all these big buildings. You can raise equity or you can use debt to fund the buildings. What do you think Las Vegas Sands used? It used a lot of debt. Why? Because Sheldon Adelson owned 52% of the shares in Las Vegas Sands. He was afraid that if he issued shares, that his holding would drop below 52% because he wanted to control the company. So he issued debt. And when things were good, everybody celebrated. So they had a ton of debt by 2008. And then, of course, you had the market crisis. So this was the valuation of Las Vegas Sands in February 2009. I have to tell you, as I was doing the valuation, I was surrounded by news stories that were full of bad news. News like Las Vegas Sands probably will not make it, might have trouble making its debt payment. I shut those off, did my DCF valuation, following all the rules in the book. Improve margins, reduce debt ratio. I made this company a healthy company on my spreadsheet. And I came up with a value per share of $8.12. So you know what I mean by healthy company, right? The margins have to improve, the debt ratio has to come down. I have this nice healthy company, value per share of $8.12. Stock was trading at $4.25. Ask me the question. Did I buy it? I wasn't even tempted. And that led to some soul searching, because if I believe the value is $8.12, I should be buying at $4.25, right? So I said, what am I so scared about? And what I was scared about was all those news stories that I was reading that Las Vegas Sands would not make it. And when I did the cost of capital for Las Vegas Sands, I gave it a high cost of debt, but in spite of doing all of that, their cost of capital really did not budge that much. So I finished the valuation and I said, what will happen if they don't make it? And what's the likelihood that they will not make it? And I actually got luckier because Las Vegas Sands actually has bonds outstanding, which are traded. Now, normally the way you price bonds is you take the promised coupons and you discount them back at a risk-adjusted rate. I did something slightly different. I took the promised coupons, but to get the promised coupons, what has to be true? The company has to be around to make the payment, right? So I multiplied each promised coupon by the probability that the company will be around. And because I'm adjusting the cash flow for the risk, I could discount back at the risk-free rate. And the bonds are actually trading at about 52.9% of face value. They were trading at a massive discount. I solved for the probability of distress. In other words, I'm letting the bond market tell me what the chance Las Vegas Sands will not make it is. And here's what I found. Based on that bond price, the bond market is telling me there's a 77% chance that Las Vegas Sands will not make it. So let's step back. I have a value of $8.12 on the assumption that Las Vegas Sands makes it and becomes a going concern. But that works only the 23% of the time. It's a going concern. The remaining 77% of the time, what's going to happen? The company's not going to be able to make a debt payment. I'll have to stop, liquidate my casinos, and pay off the outstanding debt. And if I do that, I can almost guarantee the equity is going to be worth nothing. They have so much debt. My expected value is a weighted average of the two numbers, the DCF value and the fact that my equity will be worth nothing. My value per share was $1.92. $4.25, I shouldn't be buying. With distressed companies, remember that last leg matters. So let's stop there and we start back up on Monday. We will talk about emerging market companies. What's your sales capital? Your revenues go from 3 billion. What are your revenues changing like next year? Because your reinvestment should be roughly. I'm sure these people do have reinvestment. What are the reinvestments? You can front load it. Basically what you've done is smooth out the reinvestment over the next 10 years. They might choose to front load it. That's not going to change the DCF very much. You see what I mean? Because it's the sum of the reinvestment over the next 10 years. What you should probably look at is look at what you're reinvesting over the next 10 years. My guess is you're reinvesting 10, 15, $20 billion. If you're reinvesting a lot, you're just spreading it out over time. What they might choose to do is actually do more of the reinvestment up front. That shouldn't change around the next year. Okay.
I just have one question about the end of the class. We started talking about finding the distress value, and it kind of relates to what I first asked. Is it factored in? One of the fundamental concepts of valuation is that there are market inefficiencies, but
No, it's not a concept of valuation. Concept of acting on valuation.
Oh, concept of acting on valuation.
Because you can do valuation and believe in valuation.
Sure. So, why would the debt market
Be more efficient.
right? Or why would you have the confidence to believe
Because
that?
here's what I'm going to argue, right? Even if you don't believe that debt market is efficient, you can lock in the arbitrage. So let's say the bond market is sending out a signal that there's going to be a high probability of distress.
Okay.
And you believe that there's a low probability of distress. Let's say that's true. How would you make money?
Okay.
Let's say the equity market is building in a very low chance your company will not fail, and the bond market is building in a very high probability that your company
Okay.
will fail. Right? So if there's a mismatch between the two markets, you're going to go buy the bonds of the company,
Right.
and you're going to sell the equity in the company. You're not even making a bet then on which one is cheaper or expensive. You're just saying, if the two markets are looking at the same company, you can't have two views. It's called, there are hedge funds that actually do this. That
Okay.
actually take the same.
The investment return in that strategy would all be based on
Mispriced.
a risk-adjusted return.
Right, on a mispricing. Basically, you're saying distress is a factor. It's got to be priced by the bond market to the price of the bond.